Welcome to Investors Hangout, brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Coronavirus has created such havoc in the lives of the people that it is unprecedented. Equity markets too have plunged dramatically. What should an investor be doing in such a scenario? This is what we will discuss with the CEO of Value Research, Dhirendra Kumar, who is with us. Dhirendra, welcome. A very pertinent question which comes to my mind is, what happened?
Oh, panic. And panic for understandable reason. It is not on fictitious reason or something. It is rooted in facts that, this virus has implication for the economy in general, companies in specific, and rightly so. And and still playing out. I don't know what the impact will be. It's just not about schools, cinema halls, and people not going to the malls, consumers not consuming enough, people not traveling enough. It's not limited to that. Now, this is just the beginning. I don't know how long it will linger, and it is very difficult to anticipate that how long will it take for it. It's not a matter of how many people will die of this virus. It is also a matter of how many people, how many businesses, how the scare around it, the preparedness for this, the way to deal with it is something which has huge economic implication, and that is going to affect companies.
Given that the cure might take many months or a year to...
Even if it takes 3 months, 6 months, but if people are going to be, remain indoors, if they are discouraged to travel around, that itself will have a huge impact because people have to make a living, businesses have to, this is a big derailment across the globe, in the cities primarily. And I don't know how it'll, it's very difficult to anticipate that what will be the rate of growth in India. We are just beginning to see some cases, how it expands, how well we are able to deal with it, to contain it. And even if we are able to, businesses will still be hurt. So, and how long it takes to resolve when we are able to get back to normalcy, where we say that, okay, life is, normal, back to normal. So, understandably, and that's why the markets are really not only in panic, it reflects great confusion. Because one day it went up by, so far we have lost about 20% of our equity values. Mutual funds in general, on the broad indices too. And I don't know, every day we just might start to, get some kind of suckers rally, in a sense that people will say that, this has become so cheap, let me buy again. And it will fall down again after a few days. If any fall or any rise is never in a very linear way. It goes up and down. So, the broad direction will be down, and it's going down till we actually see. We are able to quantify what kind of, what's the time frame and what is the general, resolution of the problem. So, this is presenting a huge, opportunity as well as threat to investors.
A thought comes to my mind that earlier market and finances or financial forces created turmoil in the financial markets. Here, it is something which is out of the purview of the market or financial reasons. This is something which is outside that. As you very rightly said, you don't know when it'll have a solution, when we will have a solution to this. So, under such circumstances, you think the market will be able to bounce back?
Yeah, markets will bounce back, because markets will bounce back. That I don't know. I wish I knew. And nobody knows. And that is why you see this total panic and confusion. Simply because how long it takes for it to resolve. And when people think that it is back to normal, that is the state. And that can take any time. And this is still playing out. It is also not a matter of central governments acting in concert to resolve a problem. 2008 crisis, central bankers did act. Indian government, Indian Reserve Bank did act in terms of creating a supply, creating a policy framework so that investor confidence is restored. This is not about investors' confidence. This is general scare. and general scare, which is important, caused by the government because they are taking precaution, and that will lead to deceleration of economies. That will lead to slowdown in consumption. That will lead to disruption in the way we conduct our affairs every day. So very difficult to anticipate. But I think good businesses will make money over a long period of time. Humanity is not coming to an end. Businesses are not dying. In fact, it will create a great opportunity for some of the better businesses, good businesses, that the weaker ones will actually get weaker or die, and the better ones will actually do better. So this will drive even more quality orientation in the market. But we don't know which ones. Right now we are seeing this reaction that airline stock falling or on a free fall, or the cinema stock on a free fall, some other stocks on a free fall. But over a period of time we will find out that some things are more resilient. We still need to consume things. Businesses produce those goods and services which people use, and earnings will unfortunately the Indian situation is little grim than the global scenario, that Indian markets were not in a bull phase. They were not like the American market, which was going up for last 10 years and it got disrupted because of this. We were not doing well anyway, and we were trying to get our act together. We were just reorganizing ourselves, our affairs in terms of bank NPA, many other resolutions, dealing with the changes in the way business is conducted in this country. And this is a massive blow, that a fall on at a point when we were not doing very well. But that apart, I think investors don't have much of a choice in terms of what they should do, except managing, controlling what is in their control, managing their stuff.
So what would you tell the investors how to go about dealing in such circumstances?
One is that there'll be two kind of reaction. One is that a lot of investors would like to realize whatever, would like to walk out of the market. Don't do that. If you have been watching this investors hangout, and if you have been following even a part of the plan that you are investing your long-term money and you are a regular investor, don't do that. It will make your losses permanent. The other is that you will be tempted to profit from the opportunity created by the market, that okay, it has become cheaper. Even don't do that very aggressively. Do it in some methodical fashion, that if you are lucky to have that money, spread it over the next 4, 5 months, 6 months. Because if you invest a large sum of money and a massive decline in values thereafter, you will have great regret and you will be driven out of the market forever. And trying to time it perfectly, that is something which most investors would like to attempt. Don't do it. You can't do it with perfection. Maybe the conservative investor should do if at all you have money, spread it over the next 1 year on a weekly basis. If you are a little aggressive, still spread it over the next 3 months. So you won't have that deep regret of because this volatility is very difficult to deal with.
Okay, so these are the tangible things that a person can do. What about the intangible things? What do I do about the fear that I have in my mind? Okay, Mira's hard-earned money is gone.
You can't do much about it. It's gone. If you want, it's gone only if you are able to. If you have to really redeem your investments. So don't do that. And for that, it's important that you invested the money which you don't need for a couple of years anyway. Cut your media exposure. That will scare you, and it'll grow on you even more. The other is that manage what is in your control. Make sure that you are able to de-risk yourself on the health front, because that is an even bigger risk. And the basic principles which we keep reinforcing all the time, even at the cost of sounding like a stuck record, that diversify, be a regular investor, have your asset allocation which is aligned to your temperament, your experience, and your investment time frame. Never invest your short-term money into equity. So if you follow these things and avoid the extremes, and avoiding the extreme is actually following these rules, because the real problem is that if you invest 10 lakh rupees to profit from it and it becomes 7 lakh rupees overnight, it will drive you out of the market. So if you're on to any plan, stick to it. Don't take your losses,
continue with your
and
SIPs.
have that long-term orientation. This kind of thing has happened in the past, and we always look at it fondly with hindsight that, oh, that was a great time to invest.
Okay. So what Dhiren is saying that you need to stay calm and
Carry
this
on.
this too will pass.
Yes.
Okay. So we move on to the Q&A part of our program. Our first question is from Biswa Ranjan Bhattacharjee. It says, how much time can it take for the recovery phase to start? Can you pinpoint? Can you give a date or time when it happens?
Yeah.
Also, since the market has bottomed to a large extent due to coronavirus issue worldwide, is this the best time to make some lump sum investment along with regular SIPs?
I don't know how much time it will take for the recovery phase to start, because it could take anywhere between 3-4 months to 1.5 years, and it's extremely not only difficult, it is impossible to predict it because it's still playing out. We don't know the ramification, we don't know the full implication, we don't know. We are still different geographies peeking out, hopefully, and places where it's still beginning to happen, beginning to spread. The government preparedness, and I think India is so much more vulnerable because of our population, because of our health facilities, of whatever scale we have, and what is needed for this. So in that sense, we are far more vulnerable. It's still playing out, impossible to guess. But I would say that 1.5 years time on the outer limit is something when things will resolve, and things will be back to normal for a large number of businesses. Maybe some businesses get impaired because of this disruption in a fairly fatal way. But so I would say that don't try to time it. If at all you have to do, maybe if you have your SIP and you want to make some lump sum investment along the regular SIPs, maybe do a parallel SIP. Maybe do a SIP for next 12 months for the amount of lump sum that you have, for the incremental amount.
Okay.
You'll be able to average it. I think it is better to err on that side of, do it in a manner which will not drive you out of the market.
Okay. Our next question is from Siddhesh Birari, and it says, would it be right to start an SIP now when the stock market is down?
SIP it's always a good time to start your SIP.
Yeah.
And when the market is down, yes, you will benefit. But if you have been waiting for the correction to start your SIP, it's a bad strategy, because you will stop when the market goes up. So irrespective, it should be more aligned to your own savings plan, investment plan, and when you need to thinking in terms of when you need the money, and stick to it. I think that will get rewarded more than trying to guess if it is cheap or low or high or very expensive market.
Okay. Our next question is from Ganesh Sivaprasad, and he says that under the present circumstances, would it be better to shift funds required in 4 years from equity to debt?
Yes, money which you need for in the next 4 years should be moved to debt. But how to do it? Should you do it gradually? Should you start doing it 2.5 years before you need the money? I think 2.5 years or 3 years time frame is good enough for you to start preparing for it. The way we keep repeating that do your SIP only in equity, it is as much important to do your periodic withdrawal before you need the money. So do it at least 3 years before you need the money.
Okay. Instead of balance,
and gradually is the key.
Okay. Instead of balanced funds, would it not be a better idea to invest in pure diversified equity funds plus the bank FDs, given the complex and not so good debt market, especially if someone can do the asset balancing on their own? And this question has come from Mamta Mehta.
Yeah, this is one of the ways you can do it, because the key thing is asset allocation, making sure that you will be able to rebalance, making sure that you are aligned, you are comfortable with that asset allocation, 50% equity, 50% debt if you have chosen to. But my sense is that if this is a long-term allocation, assuming that you have 50 lakh rupees and you choose to invest 25 lakh rupees in equity and 25 lakh rupees in fixed deposit, then if equities go down, you will have to do some kind of premature encashment of your FDs and put money in equity. How often you do it, and tax efficiency of the fixed income of fixed deposit vis-a-vis the debt fund. Debt funds turn out to be far more tax efficient. My suggestion to you will be consider not the very fancy debt funds. Be very conservative about it. Choose the liquid fund. Choose the ultra short-term bond fund. They don't have significant downside. Anyway, you are taking the equity risk, so you understand the volatility, and they are not as volatile. That be a better option. But it's important that if you find that complex, go ahead with your bank FD and equity fund. It's the second best thing anyway.
Nikhilesh says that I chose my SIP based on the value research star rating. What should be my strategy if the rating gets downgraded? Should I continue to invest in it, hold it and start fresh investment in another fund, or should I sell the investment completely in that fund?
Our star rating is one of the inputs to your choice, and that should not be the only basis on which you should be choosing your investment, because there is much more to it. I think more important than the star rating will be the appropriate kind of fund, whether balanced funds are more suited to you, or hybrid aggressive equity funds are more suited to you, or multi-cap funds, or combination of mid-cap and small-cap funds. So those categories, that's the first thing, the more appropriate category. Then comes our rating, and our rating is a first filter, but I don't think it's a conclusive filter. But if at all you are guided only by the rating, I would give you a more general rule to follow, that 5-star, 4-star looks like a very comfortable fund, and they generally prove to be good funds with sustained performance. And this is primarily valid for equity and balanced fund. They turn out to have, the basis is very straightforward, that they have delivered superior risk adjusted return. 3-star fund, I would say they are the average, and slip below 2-star, I'll be worried. So these actually the star rating should be a prompt to thinking. It should provoke you to think that has the fund turned really bad, and these ratings are actually a rough guide of an indicator of that kind. So yes, completely sell the fund once it sells below 2-star and below the 3-star rating, and consider that, but look beyond rating. Rating may not be complete in itself.
Okay. Do these rating get evaluated over a period of time at Value Research?
Yes, they get revised every month, and it's entirely a quantitative measure. It is based on it is a comparison of funds of similar kind, and how it has delivered return,
and how they stand
and as compared to the volatility that has been visible in the fund.
Our next question is from Kunal Sharma, and he says, given the situation that the economy is now at this point of time, in this economic environment, where should I invest if I have a horizon of only 1 or 2 years?
You should consider nothing beyond. You should not think in terms of which sector or equity fund at all. Okay. You should consider, though it might turn out to be a great time to invest, but I don't know. We've given 2 years time frame, and after 2 years, you definitely need the money. Only fixed income funds are your option, and err on the side of caution. Just be into ultra short-term bond fund or liquid fund, and that's good enough.
Okay. What are the market cycles? And this question has come from Julius Moylan.
Market cycle, things go up and down in a certain time frame, and for an understandable reason that demand leads to economic cycles. They always tend to they never get in a linear fashion. They don't happen in a manner that is predictable. So things go up and down, and in a couple of years time we see the cyclicality of the market, the economic cycle for various sectors. So that is what market cycle is. Things go up and down.
I've heard,
and that's the nature.
Yeah, I heard you many times say that an investor must experience the
A full market cycle, because
market cycle. What is the importance of that?
Importance of that is that, you know, if you are investing through the lean time, you will not see returns, and only when the up cycle comes, and then this happens in a very natural way.
Okay.
And sometimes these cycles are longer, sometimes they're short. But in our sense, you know, we have tried to, you know, simplify it, that typically you are able to capture a good part of the market cycle in 3.5 years time frame.
Okay. Our next question is from Nuthi Raghu Varun. How is a focused multi-cap fund different from a regular multi-cap fund?
They have fewer stocks. Focused multi-cap funds, all focused funds, they have fewer stocks, and they say that there's 15 stocks, 20 stocks, 25 stocks. So if, you know, it comes with its own set of risk and return potential, that if you go right with your focus strategy, if you're right with the stocks in your focus portfolio, it turns out to be much more meaningful. Regular multi-cap funds tend to be more diversified. 40-50 stocks could well be the norm.
With that remark from Dhiren, it's time for us to wind up today's program. Thank you, Dhiren, for answering the questions of our viewers. As Dhiren said, the mantra is keep calm, this too shall pass. Signing off, my name is Rajesh Lake, and with me is Dhirendra Kumar. Bye for now.